This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation.
Hello and welcome. I'm Bess Foley, a nonprofit financial management consultant for small and mid-sized arts and human service organizations in the DC metropolitan area. This presentation is one of several sessions covering basic accrual concepts. In this session, we will focus on prepaid expenses. But first, let's touch on what accrual accounting means. Accrual accounting matches income and expenses in the appropriate fiscal period, regardless of the timing of cash inflows and cash outflows. Why do we do this? Well, aligning income and expenses helps organizations to understand their business model and determine whether certain activities have a surplus or may need to be subsidized. This can be helpful in making a compelling case to funders. For example, you can only know that ticket sales and sponsorships cover only 55% of the cost to mount a theater production if you have aligned the relevant income and expenses to create a profit and loss just for that program. In addition, recording receivables when they are promised and payables when they are incurred gives you a more accurate real-time picture of your organization's current fiscal position and its committed revenue and expenses. So how do we do this? Well, balance sheet accrual accounts are used as temporary holding accounts until the time is right to move them to the profit and loss. These are the 6 basic accrual concepts. As mentioned, for this session, we are going to focus on prepaid expenses. So what are prepaid expenses? Simply put, when a purchase is made during one fiscal period, it may pertain to another subsequent fiscal period. In that case, we call it a prepaid expense. An accountant friend of mine refers to prepaids as expenses waiting to happen. Examples of prepaids might include things that your organization has purchased for future use, such as merchandise, inventories, supplies, or brochures promoting events that will happen next year. Payments your organization has made for goods or services that have not yet been received or used, such as insurance premiums that could be refunded if canceled, or deposits to attend a future conference. Inventory items for resale are a type of prepaid expense and may involve accounting for cost of goods sold as depleted, but that is a much more complicated process that will be covered separately. So where do prepaid expenses go? Prepaid expenses live on the balance sheet as an asset while they are waiting to be converted to expenses in the profit and loss, sort of like a parking lot. Using accrual accounting, these expenses are held in the prepaid expense balance sheet account. When the purchase is made, cash is decreased and the prepaid expense account is increased. The purchases are not counted as expenses in the profit and loss until the items purchased are used, such as supplies or insurance, etc., or when the related activity takes place, i.e. the conference or the class or the service. So let's see what that looks like. Here's a comparison showing what happens in cash accounting versus accrual. In the first example, in this example, expense for Period 2 is made during Period 1. In cash basis, in the first column, you can see that the expense would be in the wrong period. The purchase is made, cash goes down, the expense goes up, but the expense was for the second period, but it hits in the first period in cash accounting. In accrual, the expense is parked in the prepaid expense account on the balance sheet when the cash is dispersed in period 1. So it's an expense waiting to happen. Accrual accounting allows the expense to be recorded in the profit and loss in period 2 when the related activity actually occurs. So if you look at the accrual box, when the cash goes down in period 1, the prepaid account goes up, but then in period 2, we move it out of the prepaid, decreasing it, and increase the expense in period 2, which is the appropriate period. For you bookkeepers and accountants watching, here's the accounting flow. At the time of purchase, a prepaid expense asset is increased and the cash is decreased, as we mentioned earlier. This is accomplished as in any normal purchase. Both components of this transaction are on the balance sheet. When it's time to convert the prepaid asset to an expense on the profit and loss, the expense is increased and the prepaid expense is decreased. This is accomplished via a journal entry. The expense is then effectively moved off the balance sheet and into the P&L at the time the prepaid asset is being consumed or accessed or used, etc. To sum up, accrual accounting allows you to record income and expense to the appropriate fiscal periods and promotes a better understanding of your organization's business model and its financial position. For more information about this and other nonprofit accounting topics, visit our free online resource, nonprofitaccountingbasics.org. Thank you.